Finances and State Taxes When You Live and Work in Different States with Kathy Pfeffer-Hahn. Finances and, in conjunction with my company, Capital Coaching, helps people achieve their financial goals through personal, tailored, and attentive financial coaching services. Together, we will create a successful financial plan by examining your spending and saving habits, then guiding and educating you to your own personal success. Coaching services include evaluation of your spending plan, building your savings, financing your retirement, examining your insurance needs, and planning for your individual goals. Please contact me at capitalcoaching.net to make an appointment for a free consultation. With all the options for working online as a remote employee, it's not unusual for an employee to work in one state and be employed in another. Of course, you're going to need to file a tax return in your state, but you may need to also file in your employer's state as well. However, if you live or work in Alaska, Florida, New Hampshire, South Dakota, Tennessee, Texas, Washington, or Wyoming, you will not be charged income tax. Some states have reciprocity or a reciprocal tax agreement. That means that they agree that the state you live in will withhold taxes. This only applies to state and local taxes because federal taxes are required to be paid no matter where you live or work. Even with reciprocity, you'll need to fill out a form and file. Even if you have to file in two states, you will only be taxed by your home state and may receive a refund from your work state. There is a long list of reciprocal states, but don't assume that because states share a border that they offer reciprocity. Ultimately, it's up to the employee to request that taxes be withheld from their home state. States without reciprocity will require you to complete two returns, one as a resident of the state that you live, and the other as a non-resident of the state in which you work. But you have to make sure that your state and local taxes are paid if you're taxed in the state of your employer. What if you move during the year? How it will affect your taxes? In this case, you'll file in each state that you lived in and earned income. However, you will not be charged taxes on the same income by two different states. Each state will be able to charge taxes on the portion that you earned while living there. To file as a part-year resident, you'll fill out the part-year resident tax return. You don't need to calculate what you earned in each state. You'll just need to determine what percent you earned in each state. For example, if you made $100,000 for the year, and you're going to determine how long you worked in each state by dividing the number of months that you lived there by 12. Let's say you worked 8 months in the first state, which is 8 divided by 12, or 0.66. Then you're going to multiply that by 100. That's 66%. The remaining 34% would be your second state. That means that you'd claim $66,000 in the first state and $34,000 in the latter. Here you're going to need to make sure that you're filing the correct forms as a part-year resident. Another thing to consider is filling out an IRS address change when moving. That way, if your banking is changed, any money that you may be owed will find you, like the previous 2 years' stimulus checks. And make sure that you know the filing date for your new state. The majority do have the same as when your federal taxes are due, but some are later. What happens if you and your spouse worked in different states? You'll both file in the state's non-resident form as well if there's not a reciprocal agreement. In any case, you'd still file married filing jointly if that's your federal filing status. One word of warning, one of my friends was using TurboTax while they lived in Maryland but worked in Virginia, and that program did not properly allocate taxes, and then they were penalized by Maryland for not paying enough in taxes. There's only one way confirmed that it's correct, and that's to double-check with the state's reciprocity agreements and make sure they're withholding enough. Military service members will choose their legal domicile or the state of their legal residence and pay taxes in that state as long as they don't earn any additional civilian income. Any additional income will be taxed in the state that it was earned in. Spouses of service members may be allowed to claim their same state of legal residence as their partner if they can prove that they live there with proof of residence, like a voter registration card, driver's license, property tax receipt, or a vehicle registration in their name. You might be just wondering, how are your state taxes even spent now that we're talking about paying them? The Center for Budget and Policy Priorities found that 25% of the state spending goes towards their K-12 public education, while 13% of the funds go towards higher education, including vocational schools, community college, and universities. States also spend money on Medicaid and children's health insurance. They're also spending their money on public transportation, roads, and bridges. They pay for prisons, juvenile justice programs, and parole programs. States also support low-income assistance programs, state police, environmental programs, health benefits for public employees, pensions, parks, and recreation. Did you know that 9 states have a flat tax rate? That means that no matter how much you make, the percent is the same for everyone. This includes Colorado, Indiana, Kentucky, Massachusetts, Michigan, New Hampshire, North Carolina, Pennsylvania, and Utah. And they all charge a rate anywhere from 3.7% to 5.25%. This means that if you earn $100,000, you're going to owe $3,070, which is the 3.7%, or if you earn $1 million, you'll owe $30,700. Those 9 states and the 8 without state taxes leaves 37 states plus D.C. to pay a marginal or a graduated tax rate, just like the federal taxes. It increases as your annual income rises. But if you itemize your federal taxes, you can get a deduction equal to the amount you pay in your state tax. No matter where you live, any tax return you receive back, even a tax credit, may need to be claimed as income the following year on your taxes. Investopedia compares a salary of $78,000 and earned interest income of $3,000 in 3 different scenarios. In New Hampshire, they'd pay $30 in state taxes on the interest income at a rate of 0.38%. In Utah, that same salary would have a flat tax, and the bill would be $3,861 with a rate of about 4.95%. Other marginal rate states, the other 37, would follow a rate based on the amount earned, which could be around $4,173 with an effective rate of 5.35%. State taxes. It's just one more thing to consider while we're adulting. This is Kathy Pfeffer-Hahn. Thanks for listening to Finances and State Taxes when you live and work in different states. I know you chose to listen and I'm grateful. If you enjoyed this episode, please follow or subscribe for free in your podcast provider and then share with a friend. I'd love you to leave a review because it brings financial education to others and it helps people find me more easily. Also, let me know what questions you'd like answered or any topics you'd like covered by going to the website at financesand.net and leaving a message. You can also contact Capital Coaching for your personal financial needs at capitalcoaching.net. Finances and does not provide tax or legal advice, and nothing in this podcast is to be construed as such. Always consult a tax, accounting, or legal professional for advice on your specific situation. Remember,